How's it going, everybody? Thank you for hopping on. I will get some time if there's anyone that wants to hop on. What we're going to talk about today is where interest rates are at, where they're headed, and just kind of what that means for your money, what the Feds did with raising their short-term Fed funds rate, what that all means. And I think it's super important to know this stuff because you guys have your jobs, and it's important to know where your money is going and the people that control that monetary supply, what is it that they are doing. And I definitely want to talk about it and hopefully answer any questions that you guys may have in regards to that. So what I'm going to do here is I'm going to add in mortgage-backed securities. So in very layman's terms, you can actually buy a mortgage-backed security. So depending on what your credit score is, your home price, your debt-to-income ratio, that gets bundled with a lot of other different loans, and there's different ratings they have on these specific loans. And an investor like me or you can actually buy that specific bond, that mortgage-backed security. Kind of like when you buy a stock of Disney, the price of that stock could potentially be different the next day, and it will. Well, the appetite with mortgage-backed securities are the same way. So the Feds met on Wednesday, September 21st, and we've been in this downward trend. Not because they raised their short-term Fed funds rate by 75 basis points, but because of what Jerome Powell said in his comments. And in a nutshell, he basically said they will do anything that they can to lower inflation to 2%. Now, me and you both know that inflation is much higher. The last CPI number came in at over 8%. So these Fed funds rates that they're increasing is going to be here to stay, is basically what they were saying. And that spooked the markets, and you saw a lot of sell-offs in mortgage-backed securities and a lot of sell-off in the stock market. So again, this is inverse to the yield. So the lower the price, the higher the rate goes. We want to see green candlesticks, meaning that the price of that specific coupon, the mortgage-backed securities went up, and then the rate goes down. Something that a lot of lenders track is the 10-year yield. That tracks, typically mortgage rates, auto rates. A 10-year stands a pretty good window. And this rate has just been going through the roof. And I'm hoping that we're hitting a ceiling at 3.72%, and hopefully we can come down and see a little bit of a rebound. Let me show you guys where interest rates are at right now. My rates are going to be a little bit lower than this, but this is basically a tracker nationally. And you can see, guys, we're almost hitting 7%. We're just in that type of mortgage market right now. And for anyone that was waiting for home prices to come down, well, now may be an opportunity for you to get into something, because as the rates keep going up, you're going to see a lot of buyers pull back, and that can bring opportunity. But it's also expensive right now. So you can see here the 30-year fix is trading about 6.7%. And then government loans, FHA and VA, typically those rates are going to be lower. Those are in the high 5s, low 6s right now. So what's been going on? What does this all mean? So what's really interesting, and this is on CNBC, is we actually saw an uptick of applications. And I can know for myself personally, in the last couple of weeks, I've actually had a lot more people interested in getting pre-approved to buy a home than I have before. So you can see applications to refinance a home were actually up 10%, even with an increase in interest rates. Now, I think there's two reasons for that, guys. The first reason, I believe, is that a lot of people are doing home equity lines. I think a lot of people don't want to touch their rate on their first mortgage, but they can still secure a line of credit on their home that's much cheaper than borrowing from the credit card. So I think that increase in refinances is a lot to do with home equity lines. The second thing I believe is a lot of people are okay with taking a higher interest rate and using that money to pay off credit cards, high interest credit cards, or maybe use that money to set aside for cash. Now, I want to show you guys that. Let me finish this, sorry. And then purchase applications were up about 1%. What is really interesting is that when you take a look at cash buyers on how much it makes up the market, we're seeing about 0.25%. One out of every four offers, four transactions right now are cash buyers. Now, cash buyers love when rates go up because it takes out competition from people that are really leveraging or wanting to take out a bigger loan. Cash buyers are coming in. So I want to show you guys one thing. Now, this is for the month of August of 2022, and for there to be a crash, you have to have more supply than meets the demand. So as you can see here, month over month, meaning from July to August, we were actually down 0.4% in annualized pace, meaning the homes that were going for sale, which is down 20% year over year. Now that is just the amount of sales. So when you go on the CNBC, they're trying to spook you by saying the market is tanking, home values are tanking. No. Home sale activity is going down because of the higher interest rates and also just a lack of inventory as well. So first-time home buyers are still making up a good portion. I mean, that's almost a third of all transactions are going to be first-time home buyers, and then investors making up about 16%. So with inventory, in the month of August, it was actually down from last month at 1.28 million. Now, of that 1.28 million, that is inventory. So there are people of that there's houses of that 1.28 million that's already in escrow but has to be counted. The homes that are not in escrow that you can actually write up an offer on are under 800,000 at 779,000 active listings, meaning there is less than 2 months supply of inventory. And in a normal market, guys, there's about 6 months of inventory. So really good time if you're a buyer right now to negotiate to get seller credits that you can use for a buy down program, that you can use to do a permanent buy down, that can just help your closing costs in general. You're going to buy the home, marry the home, and then date the rate. You're going to have the ability to refinance, guys. I really do believe interest rates are going to come back down. So where would all the inventory be coming from if there was a housing crash? Let's take a look at starts. You can see we have about 1.7 million households looking to purchase a home. That's right now. The starts, homes that are starting being built, that's 1.6 million. So there's a shortage there. Single family starts, which is just single family residences, the most popular, that's at 0.94 million. Permits, meaning permits to actually start to build, are down 10% year over year, 1.5 million. Single family, again, the most important, is down 3.5% at 0.9 million. Homes that you can actually move into today, that's down negative 0.54%, 1.34 million. And then single family completions, again, that you can move in today, is at 1 million. So you can see there's no inventory, nothing showing that there's going to be this huge mass inventory that's going to help drive prices down. The only thing that's going to drive prices down, guys, right now is going to be higher interest rates, which we're experiencing right now. So the Fed's hiked their short-term Fed funds rate 75 basis points. What does that mean? Well, it's short-term. It's the overnight borrowing cost. Let's say you have Chase Bank needed to borrow $10 million from Wells Fargo. Well, that rate that they're going to be borrowing that money on is going to be anywhere from 3 to 3.25%. That's the short-term Fed funds rate. What does that mean for my money? Well, three big things you're going to see affect when the Feds increase their short-term Fed funds rate. The first thing is home equity lines. Most home equity lines are going to be an adjustable rate. You're going to see those interest rates start to tick up. The second thing you're going to see is credit cards. The APR on your credit card, that's going to go up in the short term. And then the third thing is going to be the auto loans. Those are all short-term products. Now, mortgage-backed securities, mortgage rates, mortgage loans, those are a longer-term spectrum, so they don't always coincide when they raise the rate. So the reason why interest rates went up, not because of the Fed funds rate going up 75 basis points, because that was already baked into the market, it was again because Jerome Powell was telling people that we're not even close to fighting off inflation. They believe in 2022 that they're going to decrease the personal consumption expenditure right here. That takes out energy and food prices, which are more volatile. That just shows our consumption of goods, down to 0.5%, and they want to try to get to 2%, and then in 2023 they won't even hit 2%. They believe they'll be at 3.1%. Now, this is where we're at right now, guys. This is where they want to be at the end of 2022. This is where they want to be at the end of 2023. What's that going to do for employment? You're going to see a lot more unemployment. What the Feds are trying to do is they're trying to curb inflation, meaning that they're really trying to bring prices down. And there is a very short-term negative effect they can have on that. Employers are going to start to have to lay people off. They're not going to have access to cheap money like they did before. So they're really trying to combat that by raising the rates. And a lot of investors, people like me and you, they don't have a lot of trust in the Feds right now that they're controlling that. So you can see gross domestic product. They said it was going to be at 1.7% at the end of 2022, and that's going to be contracted to 0.2%. So these are definitely this is definitely recession type numbers. Essentially, it's 2 quarters of negative gross domestic product with it coming back down. So we're in for a world of pain, I believe, in the short term. But I do believe at the end of 2023, we're going to see interest rates come back down. If you're thinking about buying a home, I think it's a great opportunity because there is a lot more negotiating power than you have today than you did before. I want you guys to pay attention to this number. So this was the most recent of September 17th. Initial claims. These are people filing for unemployment for the first time. Now, starting to see a little bit of an uptick. So we want to pay attention to that number. As people start to file more for their initial claim of unemployment, that's when we start to see unemployment rising. When unemployment starts to rise, that's when we start to see recessionary indicators happen. When we start to see recessionary indicators happen, that may not be good for our 401ks, but typically it bodes well for mortgage interest rates. If you guys have any questions or if there's anything that I can do to help look at your scenario, please let me know, and I hope to talk to you guys soon.